Silver investors, Shanghai silver futures just opened at $99, ripped to 102, and still closed the session at 96, while Western spot sat frozen at 86.40 with low volume and a blank stare. That's a $10 premium in real time, not a theory, not a forecast. A live fracture between where paper wants silver priced and where physical demand is actually bidding. If you're new here, I'm OG John AG, and this is financial warfare education using CME data, SHFE behavior, and tape structure. Most traders never even learn how to read. No hype, no calls, no to the moon nonsense. Just how to read the tape while everyone else is still watching headlines. Segment 1, Shanghai versus West, the $10 fracture. Here's what China woke up to. Shanghai silver futures opened at $99, pushed all the way to 102, and closed at 96. Western spot going into that open was 88.50, and during the Shanghai session it was stuck around 86 with almost no volume. Now, one important detail most people gloss over. The session average printed 96, but the final physical lot reportedly cleared at 102. Which one better reflects true demand, the average or the last aggressive buyer? You can debate that all day, but both numbers are still above Western spot, and that's the part that actually matters. Add in the physical demand signal we already talked about from Shenzhen recyclers, bids running $5 or more above the SHFE pre-holiday close, and you see this wasn't noise. It was the market pre-positioning before the exchange even turned back on. Low Western volume, heavy Eastern premium, physical bids above paper. That disconnect is not accidental, it's structural. Segment 2. Tape reading, the resistance zone zoom in on the Western tape. In the last few videos, we mapped out one key resistance zone, $87.20 to $89. Price has now tagged and rejected that zone 3 separate times, with still no displaced, violent hourly body close above it. Right now, Western spot is sitting around 86.40, back below that zone. 3 rejections from the same level without a decisive break. That's the tape telling you the zone is doing its job until the market proves otherwise. If you're trying to read structure in real time, you're watching for a forceful hourly body close above 89, not a wick, not a quick spike, a real close through resistance. If you're getting value from how we break down the tape, the data, and the bigger picture, drop 3 words in the comments. OG John AG. Segment 3. Volatility is screaming. Price is sleeping now. Step back and look at the options market, because that's where stress shows up first. The COMEX implied volatility index for silver options has now jumped to 134. Last time we talked about it, it had just broken above 100 and was already beyond the highs we saw on January 30th, when silver spiked to 120. This is not a normal reading. This is the options market actively pricing in the possibility of violent, potentially disorderly moves that the current day-to-day price action is nowhere near reflecting. Both the SLV volatility index and silver futures options, implied volatility, are pointing in the same direction, sharp upside price risk. Right now the price is suppressed, but the volatility index is screaming, and those two things cannot coexist indefinitely. Segment 4, SHFE manipulation and account suspensions. Then there's what happened directly on the SHFE today. The exchange just suspended another group of accounts for breaching trading rules, bringing February's total suspensions to 23. We watched heavy manipulation attempts at the SHFE open, visible, documented, flagged in real time by people tracking the order flow. The exchange responded by suspending the accounts involved. That's not a conspiracy theory, that's the exchange itself, confirming the manipulation was real enough to warrant action. 23 suspensions in a single month, verify that yourself. Segment 5, settlement pressure, paper versus registered metal. Now the part almost no one monitors, settlement pressure. March open interest as of Monday sits at 37,651 contracts. That's 188 million ounces of paper silver heading towards settlement in 3 trading days. Registered COMEX silver, the metal that is warrant issued and actually available for delivery, sits at about 88 million ounces. Roughly 2 ounces of paper for every 1 ounce of deliverable physical. The roll into May is underway. May open interest has jumped as longs move out of March, but not fast enough to erase the delivery pressure completely. February 26th is the last safe day to roll March futures if you want to avoid physical delivery risk. February 27th is first notice day, when shorts can begin issuing delivery notices, and any remaining long positions are at risk of being assigned. There's no debate there. Fuck, the clock is running. Now here's the honest read on inventory. Registered silver has stayed essentially flat to slightly down in recent days. No meaningful new metal is flowing into COMEX vaults to replenish the registered category. Segment 6, backwardation. Watch us, I need silver now. There's one more signal you should be watching very closely. The carry-adjusted basis between March and May futures. Right now the market is tracking whether the March-May spread flips from contango into backwardation. In a normal market, Futures further out in time trade at a premium to spot, that's contango, reflecting financing and storage costs. When that flips and nearby silver trades at a premium to future silver, it's called backwardation. Backwardation in a physical commodity market sends one clear message. I don't care what the paper price says, I need physical silver now. We are not confirmed in backwardation yet, but if that flips, it changes the entire conversation. Check the CME data yourself. Segment 7, Financial Warfare. Rickards, Oil, and Eastern Demand. Jim Rickards in Currency Wars described physical commodity market stress as the point where financial warfare becomes visible. It's when the paper construct that normally manages price perception starts to crack under the weight of real-world demand. That's not just a theoretical framework right now. That's a live description of what's happening between Shanghai at 96 and COMEX around 86. Now zoom out, because the geopolitical layer under all this is not getting simpler. Crude oil has pushed to $67, the highest level since August, and bullish bets on oil are surging. The question being asked in commodity markets is whether that positioning is happening ahead of a potential Iran escalation. At the same time, global oil discoveries have dropped about 40% over the past decade, from an average of 10 billion barrels per year between 2015 and 2020 down to 6 billion between 2021 and 2025. That's a structural supply problem with roughly a 20-year lag before new exploration produces first output. When oil moves on both geopolitical risk and structural supply concerns at the same time, it injects an inflationary input into the same macro environment that's already driving gold and silver higher. On the gold side, import data out of India just confirmed another record month, not a one-off, but part of a consistent pattern of Eastern physical demand running at historically elevated levels for months. Meanwhile, Western financial media keeps blaming gold's rise on momentum, and mainstream analysts still don't have a framework for why spot gold is trading at $5,130. They call it a bubble and speculative excess. What they're missing is that capital is flowing because institutions and sovereign buyers in Asia are making a quiet, deliberate judgment about where real value sits. Anyone who actually checks World Gold Council data, Indian import numbers, or Chinese ETF flows sees the same structural shift. The mainstream narrative is still searching for an explanation that fits their existing worldview and missing the shift entirely. Segment 8. Caution. Vol cuts both ways now, the honest case for caution, because balance is what separates analysis from promotion. The Shanghai session today was a perfect example. Silver opened at 99, hit 102, and closed at 96. It did not hold above 100. Price discovery was volatile, but ultimately settled below the open, which tells you there is real selling pressure at these levels. Not just manipulation, genuine participants willing to take profits or reduce exposure above 100. That implied volatility reading of 134 cuts both ways. The same explosive potential that points to aggressive upside can also produce equally violent downside moves if a coordinated intervention, a margin call cascade, or a broader risk-off event forces selling across asset classes. And remember, Shanghai closing at 96 with Western spot around 86 does not automatically mean Western prices have to catch up to Shanghai. It could just as easily mean Shanghai drifts back toward Western levels if the physical demand signals don't sustain. Humphrey Neal wrote in Tape Reading and Market Tactics that the tape tells you what is happening, not when it finishes happening. The structural story is written in the data. The timeline is written by the market itself on its own schedule. Segment 9. What the data is actually saying. So here's what the data is actually saying right now. Shanghai closed at 96 with about a $10 premium to Western spot, and the final physical lot cleared at 102. COMEX implied volatility is at 134, the highest since the January spike. Roughly 188 million ounces of paper silver are heading into settlement in 3 trading days, with 88 million ounces of registered metal available. No new metal is flowing into COMEX vaults while the drain continues. India is printing record gold imports. SHFE has suspended 23 accounts for manipulation in a single month. The carry-adjusted March-May basis is approaching a potential backwardation signal that the informed minority is watching very closely. Western price is still sitting at 86.40, below a resistance zone it has now rejected 3 times. The paper price and the physical market are not telling the same story, and they haven't been for weeks. At some point, that gap resolves, whether that happens this week, this month, or over a longer window. That's the open question. What isn't open is the direction of the structural pressure. Verify the CME volatility data. Check the COMEX reports. Look at the open interest and the vault numbers for yourself. Then separate what the data is actually saying from what you want it to say. That gap is where most people lose money. Outro. Discipline over hype. This is financial warfare education, not advice. Protect your capital. Manage your emotions as carefully as you manage your positions. The ones who do both, who read the data clearly and stay disciplined when the market gets loud, those are the ones still standing when the dust settles.